Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. So today is very important session for all of you as we are going to discuss the Monetary Policy Committee statement from the April 2026. So the Monetary Policy Committee meeting concluded yesterday and today I have brought the session for you. So in this particular session we are going to discuss that what is the impact of the West Asia conflict on the Indian economy. So in the governor's speech it has been mentioned the West Asia conflict has a big impact on the Indian economy. So what this transmission will happen, how this transmission will happen. So we are going to discuss this, and next we are also going to discuss the data point that is provided in the monetary policy statement. Okay. Then we will also discuss the domestic outlook with the new base year data points. Okay. So all of these important things we have to discuss in today's session: the impact of the West Asia conflict on the Indian economy, the data points provided by the monetary policy statement, as well as the domestic outlook with the new base year. So today's session is going to be important, and this is the first monetary policy committee meeting of the new financial year of the 2026-27. Okay, so the financial year started from April 2026 and this is the first meeting of the new financial year. So let's get started. Give me a thumbs up if I'm clearly audible and the screen is visible. Good morning, Kashish. Good morning, everyone. So welcome to the session. So today's session is going to be important for you to understand various things we will be discussing, various concepts we will be discussing. Okay, so let's get started without any delay. But first of all, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so now starting with the monetary policy statement 2026-27 from April 6th to 8th, 2026. So basically the meeting, the Monetary Policy Committee meeting, it was conducted from April 6th till April 8th, and yesterday, that is yesterday, there was the release of the Monetary Policy Statement and the Governor's Statement. Okay, so the Monetary Policy Statement for the April 2026, this the MPC, the Monetary Policy Committee, consists of the 6 members. Okay, 3 members are from the Reserve Bank of India only, and the other 3 members, they are nominated by the Government of India. Okay, so there are in total 6 members of the Monetary Policy Committee, and the chairperson of the Monetary Policy Committee is Governor of the Reserve Bank of India. Okay, so Governor of RBI is the chairperson of the Monetary Policy Committee, and he is one of the members from the RBI. So this is the idea. So Monetary Policy Committee consists of the 6 members, including the Governor of the Reserve Bank of India. The 3 members are from the Reserve Bank of India, 3 members from the nominated by the Government of India. So the Monetary Policy Committee held its 60th meeting from 6th April till 8th April 2026 under the chairmanship of the Governor of the Reserve Bank of India, who is Shri Sanjay Manotra. Okay, so this is the idea. And the Monetary Policy Committee, this is the committee of the Reserve Bank of India that takes the decision and runs the monetary policy, basically takes the decision for the monetary policy on how to control the inflation and maintain the price stability while keeping in mind the objective of growth. Okay, so Monetary Policy Committee has the responsibility to decide regarding the monetary policy, to decide the key rates of the monetary policy, to control the inflation, to maintain the price stability in the country while keeping in mind the objective of growth. And remember that the primary objective of monetary policy, the primary objective of the monetary policy is maintaining the price stability while keeping in mind the objective of growth. Okay, so this is the idea. Chalo, now moving forward, we have understood the basic idea of the Monetary Policy Committee. It has 6 members. We have discussed that the Monetary Policy Committee, it decides the key rate for the monetary policy, and the primary objective of the monetary policy is maintaining the price stability while keeping in mind the objective of growth. Okay, now today what we are going to discuss, the monetary policy statement from the April 2026, as well as we are going to discuss the Governor's statement from the April 2026, in which he has informed about the impact of the West Asia conflict on the Indian economy, as well as there is a information that was provided regarding the depreciation of rupees, that the depreciation of rupees is happening rapidly, and we will discuss that what the RBI governor has said. Okay, So now let's move forward. First of all, let's discuss about the monetary policy statement from April 2026. So after a detailed assessment done by the Monetary Policy Committee of the evolving macroeconomic situation, the situation of the whole of the country. So after a detailed assessment of the situation of the country and the financial developments and the outlook, the Monetary Policy Committee voted unanimously to keep the policy repo rate under the liquidity adjustment facility unchanged. So first of all, the liquidity adjustment facility, it consists of the liquidity adjustment facility corridor, the LAF corridor. It consists of the repo rate in the middle, the SDF rate at the bottom, and the MSF rate in the ceiling. So these are the three rates under the LAF, under the liquidity adjustment facility: repo rate, SDF rate, and the MSF rate. Okay. Now, repo rate is the rate at which the banks can borrow from the Reserve Bank of India. Okay, the repo rate is the rate at which the banks can borrow from the Reserve Bank of India. The banks have to provide collateral in the form of government securities to the RBI. So, repo rate is the lending rate of the Reserve Bank of India at which the RBI is lending to the banks. Okay, SDF rate is the deposit rate of the Reserve Bank of India. This is the rate at which the RBI is taking the deposits from the banks. Okay, so SDF is the standing deposit facility. This is the rate at which RBI is taking the deposits from the banks and RBI is providing the interest. The SDF rate, that is the interest to the banks. MSF rate is the rate, it is also the lending rate of the Reserve Bank of India, but this is the penal lending rate of the Reserve Bank of India. Once the bank has utilized the limit of borrowing under the repo rate and has taken the borrowing from the RBI till the limit, then the bank requires more money. The bank can take the higher amount of money from the Reserve Bank of India in case the bank is in the liquidity crunch or in case the bank is in the unforeseen contingency situation. So the bank can take higher loans from the RBI under the marginal standing facility. Okay, this is also the penal rate of the Reserve Bank of India. So basically, the LAF corridor, that is the liquidity adjustment facility corridor through which the RBI manages the liquidity in the economy. The repo rate is the rate at which RBI lends to the banks. RBI injects the money, provides the money to the banks. Okay, the SDF rate is the rate at which the RBI takes the deposits. So RBI is taking the deposits from the banks. That means RBI is absorbing the money from the banks. The MSF rate is the penal rate at which the RBI lends in case the bank is in the liquidity crunch or such. Now the repo rate, the SDF rate, what do you think? That the deposit rate should be higher than the lending rate or lower than the lending rate? Think from the perspective of the bank. If you're a customer in the bank, the deposit rate is higher or the lending rate is higher. The bank will give higher interest rate for deposits, or the bank will take more interest rate for loans. So remember that always the lending rate is higher than the deposit rate. So the repo rate, that is the lending rate, it is higher than the deposit rate. The MSF rate, it is the penal rate of interest at which the banks can borrow more. So penal rate, that means it is higher than the repo rate. So this is the idea. Now how much higher? So remember that the repo rate is higher than the SDF rate by 0.25% and the MSF rate is higher than the repo rate by 0.25%. So now it has been decided to keep the policy repo rate unchanged at 5.25%. So SDF rate will be how much? SDF rate will be how much? 5%, because the repo rate is 0.25% higher than the SDF rate and the MSF rate is higher than the repo rate by 0.25%. Okay, so MSF rate is 5.50%. That is the idea. Any confusion? Chalo. Next is the Monetary Policy Committee also decided. So Monetary Policy Committee has unanimously decided to keep the repo rate unchanged at 5.25%. So the SDF rate is 5%, MSF rate and bank rate, they are 5.50%. Now the MPC also decided to continue with the neutral stance. What is the neutral stance? See, the West Asia crisis is going on. The energy prices, I hope everyone knows that there is the crisis that is that is seen, that a crisis can come. The energy prices are rapidly rising. The crude oil prices are rapidly rising. Okay, there is the Strait of Hormuz, where the problem is going on that the ships, they are not able to travel very easily through the Strait of Hormuz. So crude oil crisis is going on, energy prices are increasing. The West Asia conflict, if it stretches out more, the energy prices are further going to increase, the crude oil prices are further going to increase. So if the oil prices are increasing, first of all, directly crude oil is required for the petrol, diesel, it is required for various industries. Various industries require the crude oil, as well as for the transportation also the crude oil is required, the petrol, diesel is required, that comes from the crude oil. So if the prices keep on increasing for the crude oil, if the prices keep on increasing for the petrol, diesel, you can understand that the transportation will become very expensive. The industries, their input cost is going to increase, because this crude oil is the input for, or the petrol or diesel is the input in many of the industries. So the input cost is going to increase, and with the increase of the cost of production, with the increase in the transportation cost, the prices can increase in the economy. That means if the prices keep on rising, that means this is leading to more inflation in the country. So there can be the higher inflation in the country. At the same time, because of all this conflict, what is happening, that the external demand is reducing, because the countries, they have the fear that the recession can come, that if this conflict drags on, the production uh, can be impacted, the supply chain can be impacted. Okay, so the countries, like the external demand is decreasing, the global demand is decreasing for the products of India, and that's why the growth is also impacted, because our production will reduce if the external demand is reducing for our goods. Okay, so the growth is also impacted. So right now the MPC is thinking that inflation can increase, the inflation can increase, it is already increasing and it can further increase, or the growth can be impacted, the growth might decrease because of the external factors, because of the external problems. Okay, so now our the Monetary Policy Committee has to reduce the inflation as well as try to boost the growth. So now the MPC has decided to continue with the neutral stance. If the inflation increases at a higher rate in the future, the RBI will decide to increase the repo rate to control the inflation. If the Monetary Policy Committee thinks that the inflation is not increasing, the inflation is under control, but the growth is low, so the Monetary Policy Committee of the RBI can decide to decrease the repo rate. Okay, so when the inflation has to be controlled, the repo rate is increased. Repo rate is basically impacting the interest rate in the economy. So interest rate is increased, and with higher interest rate, there are less loans that are taken. So that means there will be less money that will be flowing in the economy. There will be less demand. Less demand means prices will be controlled and inflation will be controlled. So if inflation has to be controlled, repo rate has to be increased. But if the growth has to be boosted, if we have to boost the growth, if the MPC wants to boost the growth, the repo rate has to be decreased, because at the lesser repo rate, the interest rate will start reducing in the economy. With lesser interest rate, more loans will be taken. More loans means more money will flow in the economy, more demand, more production. Okay, so basically the neutral stance has been taken, that the Monetary Policy Committee will see the coming situation. As the situation evolves, the Monetary Policy Committee will see if the inflation is rising very rapidly, then the repo rate can be increased. But if the inflation is not increasing in the future, then the Monetary Policy Committee can focus on growth and boosting the growth by reducing the repo rate. So repo rate can be increased or the repo rate can be decreased as per the future situation, as per the evolving situation. So the Monetary Policy Committee for now has decided to continue with the neutral stance. Neutral stance means that the repo rate in the future can be increased or the repo rate in the future can be decreased. That is the idea. Now coming to the growth outlook, we will discuss the domestic outlook now. Till now we have discussed the decision of the Monetary Policy Committee to keep the repo rate at 5.25%, to take the neutral stance. Now the growth outlook. So first of all, we are focusing on the domestic outlook. Under the domestic outlook, we have to focus on the growth and the inflation. Okay, so first we are going to discuss about the growth. So on the domestic front, the Indian economy remained resilient in the 2025-26. Okay, the real GDP, that is the real gross domestic product, that is basically showing the real production that happened in the economy. This is estimated to grow by 7.6% during the 2025-26, during the year, as per the second advanced estimates of the new GDP series. New GDP series basically means that the base year for the new GDP series is 2022-23 rather than 2011-2012. So rather than the base year 2011-2012, for the new GDP series, the base year is 2022-23. So BY is basically base year. So the real GDP is estimated to grow by 7.6% during the financial year 2025-26 as per the second advance estimates that are released by the National Statistical Office. The new GDP series, this is the data as per the base year 2022-23. Okay. Next is private consumption. Why there is the growth of why there is the growth in the production, why there is growth in the real GDP by 7.6% in the 2025-26 financial year. So the private consumption and the fixed investment contributed significantly to overall growth. Basically, the demand in our country was high, because of which the production was high. So the private consumption, the consumption of the households, and the fixed investment, that is the investment in the assets, this contributed significantly to the overall growth in the country, and that's why the real GDP increased by 7.6% in the financial year 2025-26. While the net external demand remained soft, as I've told you that because of the various problems that are going on at the global level, the external demand is decreasing. The external demand for our products, this is decreasing. That means our exports, the merchandise exports, that is the goods exports, they are decreasing. Okay. Next, on the supply side, estimated real GVA growth. So if we see from the demand side that we take the real GDP, the real gross domestic product, but if we see from the supply side, we take the gross value addition. Gross value addition, that is how much value addition has happened. Okay, so on the supply side, estimated real gross value addition growth of 7.7%. This was driven by the buoyant services sector. The services sector is still very healthy, and robust manufacturing activity. Okay, so this is the idea that in 2025-26 the growth was good. For the real GDP, the growth was 7.6%, while for the GVA, gross value addition, the growth was 7.7%. Okay, next, now looking ahead for the financial year 2026-27, what is the situation? Looking ahead, there is elevated energy and other commodity prices. The crude oil prices is rapidly increasing, coupled with supply shock, coupled with the supply disruptions. The distortions are coming. Okay, there is the supply chain disruption that has happened because of the Strait of Hormuz, as well as because of the war that is going on, or the conflict that is going on basically right now. Because of that, there is the supply chain disruption. Okay, so looking ahead, elevated energy and other commodity prices coupled with the supply chain disruption due to the disruptions in the Strait of Hormuz. So there is the disruption in the Strait of Hormuz, and because of this small area, or because of the small part, the ships are not able to travel very easily through this part, and the permissions have to be taken and such. This has led to the supply chain disruption. Okay, this would act as a drag on the domestic production also in the 2026-27, because the external demand is further going to decrease from India. Heightened volatility in global financial markets, because of this uncertainty, because of the conflicts, there is the heightened volatility in the global financial markets, with its spillover, with its effect on the domestic financial conditions. This would also weigh on the growth prospects and reduce the growth prospects in the 2026-27 for India. Okay, next is on the external front, that is at the global front we can say, and for India on the external front, the merchandise exports, that is the exports of the goods, they may be adversely impacted from the disruptions to the key shipping routes. And what happens that when the shipping route has been disrupted, so it can increase the freight cost, or the basically the transportation cost may be increased because of the disruption in the pathway. Okay, as well as the insurance cost can also increase, because there are more risks, there is more uncertainty, or there are more risk of the bombing and such. So the insurance cost is also, or can also increase. So the accompanying rise in freight and insurance cost in case of conflict being long drawn. So if the conflict keeps on going, if the conflict is long drawn, then the freight cost and the insurance cost can further rise. That can further become problem for our country. Okay. On the other hand, so these are the problems. Energy prices are increasing, other commodity prices are increasing. There is the supply chain disruption that has happened. The disruption is there in the Strait of Hormuz, due to which the freight cost and the insurance cost can increase. The merchandise exports from our country are decreasing. They are impacted from the disruptions. So these are the negative effects on the growth. But now on the other hand, there is sustained momentum in the services sector. Persisting impact of the GST rationalization. GST was rationalized. Before there were the 5%, 12%, 18% and 28%. These were the GST rates that were imposed, but now the GST rates are only 5% and 18%. Okay, 12% merged into 5%, 28% was merged into 18%. So now the GST rates have been rationalized. Now the GST rationalization, because of that, for certain products the prices have reduced. You can understand, before 12% or 28% of the taxes were imposed. So those taxes are not imposed now. So that's why the prices have reduced for certain products, as only 5% or 18% of rates are being imposed. So persisting impact, there is impact of the GST rationalization. There is good impact of the GST rationalization, as the prices for some commodities have reduced with the GST rationalization. Rising capacity utilization in manufacturing. There is higher capacity that is being utilized in the manufacturing sector. There are healthy balance sheet of the financial institutions and corporates. So these are the good sides, that at least on the internal front we have the sufficient demand for now. We have the sustained momentum in the services sector, persisting impact of the GST rationalization and such. Now government is focusing on the scaling up of domestic manufacturing in different areas, in different sectors. This was announced in the Union Budget 2026-27. This is a good announcement for India's growth trajectory, okay, that the government is focusing on the domestic manufacturing and is going to boost the domestic manufacturing. Taking all these factors, the negative factors from the external front, the positive factors from the internal front, taking all these factors into consideration, and on the assumption that the adverse impacts of the conflict would remain contained in the near term, that we are assuming that if the adverse impact of the conflict, they only remain for the short term, then the real GDP growth of India for the 2026-27 is projected at 6.9%. But what if the conflict drags on? So further escalation of the conflict, its continuation over a wider geographical spread, and uncertainty regarding the damage to the energy infrastructure apart from weather related events that can happen in India, they pose downside risk to the domestic growth outlook. So if we see that the conflict is contained in the near term, then it is expected that the real GDP growth for 2026-27 for India is projected at 6.9%. But if the conflict is not contained in the near term, if it drags on to the wider geographical area and such, as well as if there are weather events that happen in India, so they can lead to downside risk to the growth. Now coming to the inflation part. So as per the new CPI series, basically before the consumer price index had the base year 2012, but now the new CPI series have the base year 2024. Okay, so the new CPI series, that means the CPI with the base year 2024. Now CPI is the consumer price index that basically shows that how the prices are being impacted for the consumers, for the consumer goods that are consumed by the people like you and me. Okay, so basically the consumer price index inflation, this shows the inflation, or this shows the rise in prices for the consumer goods that is impacting the consumers in the country. Okay, so this, see, whenever we talk about inflation, whenever the RBI or the Monetary Policy Committee is talking about inflation, they want to control this inflation. Okay, they want to control this inflation. The target is 4%. The inflation should be around 4%, within the range of plus minus 2%. Inflation should not go below 2%. Inflation should not go above 6%. So whenever Monetary Policy Committee wants to control the inflation and wants the inflation to be around 4% or within the range of 2 to 6%, so this inflation is basically the CPI inflation, the inflation that is affecting the consumers. Okay, this is the inflation that is affecting the consumers. So as per the new CPI series, the headline inflation, that is the retail inflation, that is the CPI inflation, it increased to 3.2% in February 2026. So the inflation is within the range of 2% to 6%. and the inflation is around 4%. So that is a good news that the inflation is not going out of bounds in our country. But the inflation has increased from the 2.7% in January to 3.2%. Now, while food inflation increased in February, the core inflation. Now, what is core inflation? Anyone can tell me what is core inflation? Core inflation is basically CPI inflation, excluding the food and fuel prices. That is, core inflation is the CPI inflation minus the volatile prices. So the rest of the prices are taken into account, like for the manufacturing goods, for the precious metals and such. So the core inflation is the CPI inflation minus the food and fuel prices. Okay, so this is the core inflation. This remained unchanged. So that means because of the food inflation, the headline inflation, the retail inflation has increased. Excluding precious metals, if we exclude the precious metals also, the core inflation remained moderate at 2.1% in January and February, suggesting subdued underlying inflation pressures. That means from the manufacturing goods, the inflation is not coming, or from such kind of goods the inflation is not coming. Okay, so inflation is mainly from the food side, and that also is contained because the inflation is only 3.2%. Now, the ongoing conflict has led to the large volatility in the international energy and other commodity prices, imparting considerable uncertainty to the near-term inflation outlook. Because if the energy prices keep on increasing, other commodity prices keep on increasing, that will impact the whole of the India. Okay, if the energy prices are increasing, if the crude oil prices keep on increasing, that means the petrol, diesel, LPG cylinders, they will become expensive. The prices will increase. If the petrol and diesel is becoming expensive, that means the transportation cost will increase, the cost of production will increase. Okay, the pass through of higher global energy prices, because of the higher global energy prices, it has led to the increase in the price of selected fuels such as the premium fuel and LPG and diesel for the industrial use. So because of the increase in energy prices, for now there is increase in the premium petrol and the LPG prices and diesel for the industrial use. But slowly and slowly, if the prices keep on increasing, if the energy prices keep on increasing, there will be faster increase in the prices of the LPG cylinder, diesel and petrol and such. Okay, for now it is contained for the industrial use, but slowly and slowly it can start impacting the consumers also, the other people also. On the other hand, the near-term food supply prospects have been boosted by robust rabi crop, providing some comfort. So at least from the food side, the crops, they are showing resilience, and there is healthy growth that is seen. So right now the energy prices that are increasing at the global front, this has led to increase in prices in select fuels such as the premium petrol, LPG and diesel for the industrial use. If the energy prices keep on increasing, it will directly start impacting the consumers also. Okay, considering all these factors into account, CPI inflation for 2026-27 is projected to be 4.6%. So we are expecting that, okay, the inflation will be around 4%, and within the range of 2% to 6%, it will not go out of hand. Okay, now the persistently elevated energy prices due to the West Asia conflict and possible El Nino conditions. El Nino conditions, they could have a negative impact on the southwest monsoon. Okay, so El Nino conditions, they have the negative impact on the southwest monsoon. So that's, if the southwest monsoon is impacted, you can understand that the crops will get impacted. So the persistently elevated energy prices and the possible El Nino conditions, they pose upside risk to the inflation. The inflation can go above also. Okay, it can rise out of 4.6%. So core inflation, that is the CPI inflation excluding the food and fuel prices, is projected at 4.4% for 2026-27, and excluding precious metals, if we exclude the precious metals also, it is even lower, indicating that underlying inflation pressures are expected to remain contained within the limits. Okay, now coming, this is what we have discussed. We have discussed the Monetary Policy Committee statement. The Monetary Policy Committee has decided to keep the repo rate unchanged, keep the neutral stance, as well as considering all the factors. CPI inflation for 2026-27 is projected at 4.6%, and considering all the factors, the real GDP growth is projected at 6.9% for 2026-27. Now coming to the governor's statement, where we will discuss the impact of the West Asia conflict on the Indian economy. Any confusion till now, anyone? Correct, Ria. Well done. Any confusion, anyone? So now, what is the impact of the West Asia conflict on the Indian economy? As per the governor's statement, it was said that there are five. See, let me briefly, so governor said that let me briefly inform on the channels of transmission through which the Indian economy may get impacted by the ongoing conflict. So how the Indian economy is going to be impacted through the ongoing conflict? Are we a part of the West Asia conflict? Uh, is India a part of this conflict? No, we are not directly part of the conflict. Okay, we are not directly engaging in war or engaging in this conflict. So, if we are not directly the part of the conflict, if our country is not getting involved in the military operations, then why are we getting impacted? What is the form of transmission of the problem in India? Okay, so what are the channels of transmission through which the Indian economy can get impacted by the ongoing conflict, which is not involved India in any way in the military sense? If the in the military sense we are not involved, so how are we getting impacted by this conflict? So there are actually five areas where we are getting impacted. First of all, elevated crude oil prices. Elevated crude oil prices could increase imported inflation. See, we import a lot of oil. We import a lot of oil. If the oil prices increase, that means we will have to pay more for the oil. Before, let's say we were paying $1,000 one barrel. One barrel. Now, let's say we have to pay $1,200 per barrel, and we are importing, let's say, 100 of barrels or 1,000 of barrels. So for each barrel, we will have to pay $200 extra. So for 100 barrels, we have to pay $20,000 extra, and we are importing so much of the oil. So you can understand that with the increase in the crude oil prices at the global level, we will have to pay more to get the crude oil. We will have to pay more to get the crude oil. And if we are paying more dollars, that can increase the current account deficit, because current account of the balance of payment, it shows us the trade in goods, it shows us the trade in services of our country with the other countries, and the transfer payments, that is the remittances that we are getting from the other countries. So in the trade in goods, we can see that if we are paying more, for our imports, so the trade in goods can further, like the current account can further have the increased deficit, because we are paying more than what we are getting. For the exports have reduced, so we are getting less dollars, but we have to pay more dollars. So we are getting less, we have to pay more, so the current account deficit can further widen. So this is the idea that the elevated crude oil prices, they can directly increase the imported inflation. If the crude oil prices is increasing, so the prices in the country can increase and widen the current account deficit. Second, disruptions in energy markets. So sometimes it is also becoming problematic to get the crude oil or to get the energy requirements of the country. So there is disruption, there is supply chain disruptions, and disruption in energy markets, the fertilizers and other commodities may adversely impact industry, agriculture and services, reducing domestic output. Here is the article from the PIB. You can see India secures 86 lakh tons of fertilizers via Global Pact. So there were a lot of concerns that we might not be able to get the fertilizers that we need. So it was informed by the ministry that okay, we are able to get the fertilizers for now, but you can understand that if the supply chain disruptions become increased, then we might not be able to get the products that we want. We might not be, even with the money, we might not be able to import as much quantities as we want. Okay, so supply chain disruptions are persisting. So second, disruptions in energy markets, we are not easily able to access the oil, or we might face problem in accessing the oil. Fertilizers and other commodities, they may adversely impact industry, agriculture and services in reducing the domestic output. Third, the heightened uncertainty. So first was the elevated crude oil prices, due to which the current account deficit is widening, it is increasing. Second, there are disruptions, supply chain disruptions in energy markets. Fertilizers and other commodities, they may adversely impact the industry, agriculture and services. The third is heightened uncertainty. When there is heightened uncertainty, you know that the war, we don't know that how much long this conflict will go on. will it go into full-fledged war where the countries they are coming together and fighting basically? So there is a lot of uncertainty. With uncertainty there is also the higher risk. With higher uncertainty there is higher risk. Now the risk aversion is increased. That means we do not want to take the risk in this kind of uncertainty, and that's why the investors they want to invest in the safe haven, and usually the safe haven is the dollars. So many of the investors they have started to invest more in dollars. So this is the idea that with the heightened uncertainty there is increased risk aversion, and safe haven demand could impact domestic liquidity conditions, economic activity, consumption, investment, because rather than investing in India or investing in the developing nations, the investors will want to invest in the US, where which is like US dollars, which is considered safe haven. Okay. Fourth, weaker global growth prospects may dampen the external demand. Like I've told you that because of the global conflict or because of the war like situation, because of the conflicts that are going on, there is also the decrease in the demand at the global level. So external demand is reducing. With the reduced external demand, we are able to export less. With less exports, we will be producing, the production will reduce. Okay. So weaker global growth prospects may dampen the external demand of our products and reduce the remittance flows from the other countries. Finally, the fifth transmission through which the Indian economy may get impacted is finally adverse spillovers from global financial markets. If there is a lot of volatility in the global financial markets, it can affect the domestic financial market also basically. And remember that in the other countries also, with the higher crude oil prices, the prices of other commodities will increase and the inflation will rapidly increase. So the other countries will have to increase their interest rate so that the inflation can be controlled. If the interest rate increases in the other countries, so the investors will want to invest where the interest rate is higher, where the returns are higher, right? So this could lead to the tighten of the domestic financial conditions, because the investors will start taking out their money, more and more money, to invest in the countries where the interest rate is even higher. Okay. Raise the cost of borrowing also. This can increase the cost of borrowing because at the global level the interest rates will increase very rapidly. Overall, the initial supply shock. So now the conflict has impacted the Indian economy through the supply shock, through the supply chain disruption. Now till this is a supply chain disruption, okay, we are able to handle it. But what we do not want, this supply chain disruption to become the demand disruption. Because if there is no demand, let's say the internal demand is also affected. If the internal demand is also affected, if we also get worried that, okay, what will happen to our economy? We should save, we should not spend now. We have to save for the worst times. Okay. If we stop our, if we reduce our demand, basically, the internal demand will reduce and the production will further reduce. If the production is reducing, the employment will reduce. Employment is reducing, that means income will reduce. And with reduced income, further demand will reduce, further production will reduce. So basically, the RBI governor said the initial supply shock, the supply chain disruption, can potentially transform into a demand shock, and this is what we do not want. Okay. So that's why we have to restore the supply chains, and we do not want the supply chains restoration to be delayed. Okay. So the supply shock, right now it is a supply shock that is impacting the economy, and the supply shock, if it converts into the demand shock, that means internally also the demand reduces, then the problem will become even bigger for the Indian economy. So this is the idea. Any confusion, anyone? Now coming to the last point for today. Any confusion? Coming to the last point, despite stronger macroeconomic fundamentals. See, India has strong macroeconomic fundamentals. We saw that there is higher utility capital. There is higher capacity utilization in the manufacturing sector. Service sector is buoyant. There is also the private consumption, private investment that is happening. So we have strong macroeconomic fundamentals. But still the Indian rupee in 2025-26 depreciated more than the average in the previous years. That means the rupee, its value is decreasing against the dollars. Okay, rupee is getting depreciated basically means that the rupee value is decreasing against the dollars. Before, just taking the example, $1 was equal to 85 rupees. Now let's say $1 is equal to 91 rupees. Further, $1 is equal to 95 rupees. That means we have to give more and more rupees to get $1. So the rupee is depreciating. Rupee is becoming weaker and the dollar is becoming stronger. Dollar is appreciating against rupees, rupees is depreciating against dollars. I hope this is clear first of all. Now, what is happening that the Indian rupee in 2025-26 depreciated more than the average in the previous years. In this regard, RBI governor said that let me reiterate that our exchange rate policy remains unchanged. So see, India is following what kind of policy? India is following managed floating exchange rate system. Okay, managed floating exchange rate system. That means whenever the RBI feels that okay, there is too much depreciation of rupees that is happening, or there is too much appreciation of rupees that is happening, so RBI intervenes. So in this case, what will happen that RBI, seeing that there is a lot of depreciation of rupee that is happening and RBI wants to control the depreciation, RBI do not want this much of depreciation to happen of rupees. The rupees should not lose so much of the value. So RBI will start supplying the dollars in the market. RBI has the buffers. Okay, there are nearly $697 billion of foreign exchange reserves that RBI has right now. Okay, so from its reserves, the RBI will, from the foreign exchange reserves that the RBI has, RBI will supply the dollars in the market. When there is more supply of a product, when there is more supply of dollars, if there is more supply of dollars, what will happen? The value of dollars will reduce, the price of dollars will reduce, the appreciation of dollars will stop. Okay, the value of dollars will reduce. Before we were giving 95 rupees for $1. Now the value of dollars is reducing, so we will give 91 rupees for $1. So this is the idea, the intervention. The RBI has said that we will be intervening and we continue to intervene in the foreign exchange market. This is aimed at smoothing the excessive and disrupted volatility without targeting any specific level. So RBI is saying that we are not targeting any specific level. We are not targeting any specific band for the exchange rate. We do not want a specific, we are not targeting a band or a level. But if we see that there is continuous depreciation of rupee that is happening, then we will intervene. Okay, and the RBI has also intervened from time to time. Whenever there is continuous depreciation of rupee that happens, RBI supplies more dollars in the market so that the value of dollar can reduce in the Indian market and the price of dollars can reduce and the rupee depreciation can stop for the time being. Okay, any confusion, anyone? Any confusion? And remember that the foreign exchange reserves of our country went above $700 billion. But now they have reduced, and I think the recent data is $697 billion. Okay, so this is the idea that RBI is continuously supplying the dollars in the market so that with higher supply of dollars in the market, the depreciation of rupee can be controlled. This is the idea. Chalo. If there is no confusion, then this is the first question. I hope you will be easily able to answer the question. Which of the following statements are correct regarding the latest decision of the Monetary Policy Committee? The policy repo rate under the LAF was reduced to 5%. You have to answer this question now. The SDF rate remains lower than the repo rate and the MSF rate remains higher than the repo rate. Okay, so this is the first question, easy question. If you have the understanding, you will be easily able to answer this question. Now, coming to the next question, consider the following statements regarding India's growth performance in 2025-26. Real GDP growth was driven largely by the net external demand. Services sector showed strong performance. Manufacturing activity remained robust. So which of the following statements is correct? That you have to tell. Okay, which of the following statements is correct? So this is it. I hope you enjoyed the session. Thank you everyone. I will bring more MCQs from this topic of the Monetary Policy Committee in the shorts, in the recall, revise, rise shorts that I take every Monday, Wednesday and Friday. Okay, so in the next shorts that will be released on Friday, yes, you will get more MCQs from the Monetary Policy Committee. So this is it. I hope you enjoyed the session. Thank you everyone for joining the session. Do give the answers of the homework question in the comment section. Okay, and whoever gives the right answer, I will comment below the right answer. Okay.